Hello friends, good morning, good afternoon and good evening, whenever and wherever you're watching this lesson from. Let's begin looking at this commercial activity which is known as insurance or aid to trade, okay, which is insurance. Now you should know that we have this acronym which we call WAPTIC, okay, where W is for warehouse or warehousing, A advertising, B for banking, T for transport, I for insurance, and C for communication. Now, these are commercial activities. What are commercial activities? These are services that help trade to take place. Okay, without these, trade or commerce wouldn't exist. Okay, so now let's look at insurance. Okay, let's look at insurance. So insurance is a commercial service which protects traders against financial losses caused by risks such as fire, theft, accidents, and so on. Okay, now what is the purpose of insurance? What is the function or the importance of insurance? Now you should know that insurance is important because it covers goods, assets in advance against financial against financial loss. Okay, to cover goods or assets in advance against financial loss. Number two, you should understand that it also protects employers against injury, death, okay, while at work. That T is supposed to be at. So while at work. Okay, that is the function of insurance. Now the other thing is that it covers risks such as fire, accidents, and floods. So that's the purpose. And also to indemnify, which is to compensate traders in case of financial loss through third-party claims such as public liability, employers' liability, loss of raw materials, equipment, and property. I'll explain more on the meaning of these terms in the next chapters. Okay. Now, what are the risks that a company or firms may insure against? Number one, a company may insure against theft. Okay, against theft, against fire, against public liability, accident, employer's liability, product liability, fidelity guarantee. Okay, these are risks that traders or firms may insure against. Okay, then we should also know the importance of taking out an insurance cover by traders and or business people. Why insurance cover is important by business people? Number one, if a loss occurs, a person will receive compensation, which is called indemnity or indemnified, will be compensated. He or she may not end up going out of business if his or her business is large, as his losses could be large, because the larger the business, the larger the risks. Okay, and also the loss, in an event of a damage, you end up losing a lot of money or a lot of goods. Okay, so now Another importance of taking out an insurance cover is that it will give traders confidence to continue in business. For you know that in an event of damage or in an event of a risk occurring, you are going to be what? You are going to be compensated. Okay. The other important thing is claims against him or her may be large. Okay, may be large, and without insurance, he or she may not be able to meet huge claims arising from the members of the public who may suffer losses. Okay. Last but not the least, number 5. So it is required by law to protect the general public. For example, employers' liability and public liability insurance. Okay. Now, let's understand this term, pooling of risks. Pooling of risks. What does it mean when you say pool of risks or pooling of risks? Now, this is when people with common risks pay into common fund an amount known as premium, from which the disadvantaged or the unfortunate are paid from. Okay? The burden is made lighter than it would have been. Okay? This is supposed to be done. Okay? Than it would have been. Okay? Than it would have been for a small amount of premium. The insured is made to be paid the insured property. For example, the property worth 10 million might be insured for a premium of 300,000. Why? This is because there are many who wish to insure against the same risk. So many premiums are contributed, but there are proportionately fewer claims. Hence, it enables the fortunately people to help the unfortunately ones. All right. Now, how is this pool? How is this money from the pool used? The insurance company use this money, number 1, to pay compensation to those who suffer losses. Number two, to meet the running expenses such as salaries, rent, bills, okay, etc. Number 3, to pay dividend to company shareholders. If you are a shareholder of the company, you'll be paid dividend, okay. Number 4, surplus funds are invested in property business and some lent out to what? To the government. Now, friends, let's look at business risks. Now, check this one. When it comes to business risks, you have two types of risks. Two kinds or categories of risks. We have what we call insurable risks and non-insurable risks. Okay, this is supposed to be insurable. Okay, this is supposed to be insurable. Not insurance risks, but insurable and non-insurable risks. Now, look at this question. We have a question here saying, explain and give. Okay, explain as to why some business risks are non-insurable and others are insurable. This is what I want to explain. Insurable risks. What are insurable risks? These are risks whose chances, these are supposed to be chances, not changes, so you can change this one. Okay, these are risks whose chances of occurring can be mathematically calculated from carefully kept past records or statistics. Okay, so meaning calculated risks are used as basis for what? For premium to be charged fairly. Why you need to calculate a risk need to be calculated? For you to calculate fair premium. What is premium? The money you pay to the insurance what? To the insurance company for an insurance cover. Alright? Alright. So premium can be calculated from the past what? Past records. Okay. Examples of insurable risks, we have fire, theft, accident, damage of property. These are examples of what? Insurable risks. You should know these insurable risks. These insurable what? Risks. Now, what are non-insurable risks? Non-insurable risks, these risks that cannot be assessed. Okay? Why? They cannot be assessed due to lack of past records. Their probability of occurring is not known. Premium cannot be calculated with certainty. Example of non-insurable risks are loss of profit due to bad management, change of fashion, natural calamities. Okay, these are non-insurable risks, so you can't insure these. Okay, so that's all about insurable and non-insurable risks. Okay, insurable and non-insurable risks.